Hello and welcome. Today we have with us Aditya Khemani. He's fund manager at Invesco Mutual Fund, and under his watch, some of Invesco's key funds across mid-cap, small caps, and more have delivered strong returns, standing out among peers. So today, let's ask him how he's navigating the stretched valuations, what gives him conviction in today's market, in his stock picks, and what should investors realistically expect from here on. Welcome, Aditya.
Thank you so much, Ruchira. Thank you so much, Chirag, for having me on the show.
Good to have you here. Aditya, let's start with the big picture. So, mid and small cap valuations, they still look elevated despite the recent run up. So, do you think earnings growth can keep pace, or are we staring at the risk of disappointment?
Look, Ruchira, when we talk of equities, earning risk will always be there. Okay, so there's no way you can run away from earning risk. I mean, good markets, bad market, good economy, bad economy, that is something you have to take it in the stride. But I think point being that whether you're an investor for the next 6 months, next 1 year, or you're an investor for the next 5 year, 10 year, that makes a lot of sense from that perspective. So like in case you've come into the market 5 year back, 10 year back, it wouldn't have mattered whether earning risk would have come for which quarter and would have impacted your return. But had you come in 2 quarters back, 3 quarters back, and earning risk would have come in, it would have mattered. So point being that earning risk will always be there. It is there at this juncture also. But the moment you start thinking about the next 3 years, the next 5 years, the next 10 year, it becomes much more clearer from that perspective.
Aditya, with the slowing global growth, easing inflation, and the prospects of the more rate cuts, what's your outlook for the Indian markets going forward?
Again, Chirag, if we look at Indian markets, firstly, look, markets is a function of economy. In case economy does well, markets will do well. So I've been in the market for now 20 years. Probably the Indian economy, the macro what we are right now, probably that is the best we've seen over the last 20 years. So that is one point. Secondly, on the micro side, even though macro might be great, there will be some cyclical correction which happen in the economy at different points in time. So we went through from 2020 to 2024. We saw a Goldilocks period from an economy point of view. I mean, everything was recovering and people were excited from that perspective. But last 1 year or last 1 year and a quarter, maybe things have not been very great from that perspective. Because as I said, cyclically, the rate increases and all those things, the monetary tightening, what happened in the economy, that had an impact in terms of economy slowing down over the last 4 5 quarters. But we've seen 2 quarters back, the RBI has done taken a lot of steps to maybe recover the economy. Also, the government is also doing its bit in terms of making sure that the economy revives back from that perspective. So no one knows. It takes time, 2 quarter, 3 quarter, 4 quarter. At some point in time, our view is that over the next 4 quarter, at some point in time, you will see things coming back to normalcy from that point of view. But having said that, it will be very gradual recovery. I mean, we are not expecting that. I mean, it will be a hockey stick recovery from that perspective. It will be a very gradual recovery at the margin, quarter after quarter over the next 3 4 quarters. That is a base case view what we have.
Aditya, but if we look at the mid cap and the small cap segment, do you think the growth, particularly in these both the segments, small and mid cap, can justify the current valuations, or are we in the zone of excess optimism?
Look, Chirag, again, valuation is something, it is very, very subjective from that perspective. I mean, honestly, when people look at valuation, people simplistically look at what is a FI26 P or FI27 P, and they can come up with a judgment that this stock is expensive or this stock is expensive from that perspective. But if you look at a lot of company, India is a growth market for most foreign investors and Indian investors. And when you look at most growth stocks, 60 70% or maybe more than that value comes from maybe value which is terminal value which accrues beyond next 10 year from that perspective. So I mean, next FI26 P or FI27 P from that perspective becomes a very simplistic exercise on an overall basis. So I would say that on an aggregate basis, I will say market may be 20 25% expensive. But then in case you are backing a company which can grow at 20% plus earning growth for a long period of time, I mean, it doesn't matter obviously it matters when you buy expensive, but even if you buy 20% expensive for a company which can grow at 20% for the next 5, 7, 10 years, I mean, your return will not be meaningfully different than the earning growth. Maybe next 10-year earning growth is 20% CAGR. The stock price compounding could be 17, 18% CAGR if you buy 20, 25% expensive from that perspective. That's why we don't worry as much in case a stock becomes 20, 25% expensive. But then in case the stock is 40, 50% expensive, obviously that is something, a clear no-go area from our perspective, and clearly we avoid that space.
So as long as the growth continues, you are happy holding that stock.
No, not just growth. Look, you have to again look at a company from a lot of metrics. Obviously, we are high growth investors. I mean, in case I can share my framework, one is obviously high quality and high growth investors. But then these are two very important things. But then cash flow conversion has to be good. And these are three important things. But then at the end of the day, valuation also needs to make sense. You cannot keep on buying any company at any price, because then we've seen TMT bubble, what happened in 2000. I mean, a lot of companies, IT companies, which were trading at that point in time, they have not made a lot of money over the next 20, 25 years, even though their earnings have gone where they have gone. So from that perspective, valuation is important, but then 15, 20% valuation being expensive is still okay from that perspective. I mean, you cannot pay a 50, 60, 70, 100% over premium from that perspective, but some over premium. Look, again, we are living in a market where liquidity is chasing a lot of good companies. And then when liquidity chases a lot of good companies, it is very difficult to get a lot of hard bargain from that perspective. So there's a call you need to make. Either you stick to good companies, good quality companies with reasonable good earning growth, or maybe you sell those companies, or maybe buy companies which is a notch lower down on the quality curve, notch lower on the earning growth curve. So there's a trade-off which an individual investor needs to make depending on his investment philosophy.
Right, but mid-caps in particular, they have seen a sharp re-rating and are trading at historically high PEs. So, does their growth potential justify this, or does it raise the risk of a sharp correction if earnings stumble?
Look, again, Ruchira, mid-cap is a very wide basket. Okay. People use a mid-cap basket in one homogeneity from that perspective. But again, if you look at mid-cap composes of so many different business models, so many sectors. That's why, I mean, in an era from 2020 to 2024, when everything did well, all sectors did very well, I think the next 2, 3 years is going to be meaningfully different than that phase. It will be much more stock specific focus, because in that 4, 5 year time frame, you've seen a lot of companies have become expensive, a lot of business model which were not very great, those have also started enjoying very high multiples. So that's why as an investor, I think one needs to be very choosy where one needs to get into from that perspective over the next 2, 3 years. It will be very stock specific from that perspective. That's why I made that comment. In case a business model is good, in case you're convinced that the earning growth could be probably closer to 20% for a reasonably long period of time, I mean, I don't mind paying a 20% premium from that perspective. So valuation on an aggregate is expensive. There are chances that earning disappointment happen. There will be correction in stock price, but then as long as, I mean, you are aligned, you think like you're an investor which is investing for the next 3, 5, 10 years. I mean, those short-term aberration correction doesn't matter as long as your investment argument comes out right at the end of the day.
Aditya, you spoke about your investment style, but you always emphasize on bottom-up stock picking. So, what's the framework you use to identify high-quality businesses, and more importantly, to hold on to them through across the different market cycles?
Look, I mean, Chirag, as you rightly said, we are bottom-up stock picker from that perspective. And when you go about bottom-up stock picking, uh, at essence, we are high growth, high quality house from that perspective. But within high quality and high earning growth, you can break up a philosophy into maybe a quantitative framework and a qualitative framework. And as long as, and in terms of quantitative framework, I think today, I mean, if you ask most quality investors, it doesn't vary too much. I mean, people want high earning growth, people want high ROC, people want high cash flow conversion, people don't want too much leverage on the balance sheet. So our ask is also not too different on the quantitative side. But I think on the qualitative side is where the differentiation comes in. Because look, quantitative thing is, I mean, you can at best estimate for the next 2 3 years what the earning growth will be. But beyond that, what? Because today, as I said, stock price or stock value is maybe 70 80% composed of terminal value, which you cannot see and feel actually. So that's why quantitative factor becomes very, very important. So today, in our interaction with management, a lot of time goes in terms of understanding the softer factors. For example, I mean, for me, the management or the promoter is very, very important. So I call them the jockey actually. So jockey is very, very important because when you place money on a company, how's the top guy becomes very, very crucial. Because in case he does well, his policy is good, the company will move in the right direction. So what is the hunger the promoter has? In case, look, a lot of these mid cap people use a mid cap company, I mean, as if they are very small. These mid cap companies make 400, 500, 600,000 crore profit. So they are no, by, I mean, they are not small from that perspective. So it is very common for these promoters to become complacent actually after that, at that level. But then as an investor, you have to see, does these promoters have the same fire in the belly to make them large cap companies at some point in time? So I think for me, that is very, very important when you judge a promoter. Then you have to see, look, again, a promoter cannot carry by himself. He needs to have a good second team from that perspective. He needs to professionalize a company because, I mean, again, if you're looking at investing from a longer term, you want a 10 bagger from that perspective. I mean, the same guy, a promoter can take the company from 0 to 1, but taking a company from 1 to 10 will require a totally different mindset. So then, I mean, whether that promoter is open to getting new professional people, paying them very well, from that perspective becomes very, very important. How is the culture of the company? Is attrition very, very high or low from that perspective? So then the softer factor becomes very, very important. So the promoter is important. Secondly, the industry also becomes very, very important because look, I mean, no matter how good the promoter is, in case the industry is a slow growth industry, it is very difficult for that company to grow at a faster rate for long period of time. It can grow maybe 1 year, 2 year, 3 at a fast rate, but at some point in time, the industry growth rate will catch up with that company. So so that company has to be part of an industry which can grow at a fast rate for that for a long period of time. Here, obviously, I mean, you have to visualize. Suppose let's take a sector like hospital. You have to visualize that maybe this sector there's a lot of scope for value migration to happen from smaller hospital to larger hospitals because corporatization is happening, and then you have to bet money on those jockeys who can maybe scale up and become much larger at some point in time. So because I mean, ultimate wealth creation happens when there's a ultimate marriage of a good promoter and a good business. So these are two very, very important things which I look for on a qualitative aspect in the companies we have in our portfolio.
Now, Aditya, if we move forward to the some fund specific questions, the Invesco large and the mid cap fund has done reasonably well in the past few months or so. So, what is work for the scheme? Whether it is a stock selection, sector performance, or the overall tailwind in the market?
Look again, Chirag. I mean, last 1 2 years, as I said, 2020 to 2024, everything was doing good actually. At that point in time, it was very difficult to differentiate which is a good business model, which is a bad business model. So there had to be a method in the madness where you had to go about. So as a house, what we had done, we had chosen some themes which were much more structural in nature, and so I mean, we chose those themes which were not, they were not fads. We thought those themes can grow for the next 3 year, next 5 year at a high rate. And then from a top down view, then we went about choosing the companies or the jockeys or the promoters which could do their best within those themes. That's why the portfolio was constructed in a way that were positioned in those themes and in fund managements which were doing very well within those themes. So it was a portfolio which was very sharply positioned. We were not like 80, 90, 100 stocks in the portfolio. We were like maybe around 45 stocks in the portfolio on an aggregate base. So it was a very sharply positioned portfolio in the themes we wanted to play. And look, again, I mean, macro 1 year back, it was looking like macro is slowing down. I mean, people took notice in maybe June quarter last year, post-election, that macro is slowing down. So at that point in time, I mean, how do you then create alpha? How do you create money for investors? Then that point in time, again, you have to choose themes which can do well irrespective of things slowing down. For example, like some of the themes, like maybe a quick commerce. I mean, the theme was doing well due to it was a disruptor which was disrupting the traditional channels of distribution. So it was growing on its own. It did not need any macro support from that perspective. A theme like hospital, again, value migration was happening from unorganized to these corporate hospitals. It did not, and it's a non-discretionary consumption from that perspective. It did not need any macro support from that perspective. Again, one more theme, financialization. I mean, again, financialization is a longer term theme where people are moving from a physical asset to financial asset. Again, that theme was doing well irrespective of macro slowing down. So we positioned our bets in terms of some of these themes which could do well in spite of macro slowing down. I think so that helped us a lot. And on an aggregate basis, because you asked us that question whether stock selection helped you or sector selection helped you. Look, I mean, for a fund manager, there are two ways to create alpha. One is called the allocation effect. The second is called the selection effect. And in case we see last 12-month performance, 80-85% of alpha has been created out of selection effect. And that is not just for large and mid cap. That is for mid cap and that is for small cap. So because as I told you, we pride ourselves from a bottom up stock selection perspective. We don't want to take big bets on the sector side, and then I mean, because look, sector calls can go right at some point in time, they can equally go wrong at some point in time. So we don't want to be at the mercy of the market, that we want to be up one day and down one day. So stock selection is, I think, what has helped us on an aggregate basis do well the way we've done over the last 1 year.
Right now, this large and mid cap fund, it also runs a relatively higher mid cap exposure compared to its peers, even when large cap stocks look attractively valued. So, what is driving that positioning?
Look, again, Ruchira, if you look at the large and mid cap fund today, large cap is around 40% of the fund, and mid cap and small cap is around 60%. That is the allocation at this juncture. And if we look at the benchmark will be around 50-50 between large and mid cap. So we are probably, I mean, higher index to the mid and small cap part of the market. So here, I know that a lot of people have come out and said large cap looks cheaper from that perspective. But again, one is optical cheapness. The other is what is the earning growth of those companies. So when we look at, because I manage large, mid, and small across, when I look at the large cap segment, a lot of these large cap companies have become very big actually. So they cannot grow much larger than the GDP growth rate of the company because they are present in segments which have matured. Like a lot of these probably IT majors. The IT services is a matured segment from that perspective. And some of these companies like 20-30 billion dollar revenue. So you cannot expect them to grow at a rate faster than the economy. And then, so I mean, they will be optically cheap. So they will be available at 18p, 20p from that perspective. So, I mean, the large cap index, because is comprised of a lot of these companies, optically they look cheap, but then they lack that earning growth beyond a point. So in my view, large cap as an aggregate basis, probably they will go closer to the GDP growth rate of the country. And in case one is looking for a higher earning growth, probably mid and small cap part of the market is where you'll get high earning growth. And because where we position these funds is high earning growth and high quality fund, we want earning growth to be high across our funds. And most of our funds earning growth will be closer to 20%. And that can only be achieved if we have a higher share of mid cap and small cap on an aggregate basis overall in that fund. But again, look, a lot of people construe that because it has a high mid cap or high small cap, the risk character of that fund will be high. But that might not necessarily be true. For example, if you look at a sector like healthcare, healthcare is a big sector across the funds. I think in the large and mid cap also it will be 18, 19%. In the small cap, it will be 20% plus. In the mid cap, it will be 20% plus. We know that healthcare is a very defensive sector. So, and most of these healthcare stocks we have is in the small cap and the mid cap space. So even though we might have a lot of small cap and mid cap, but in case they are present in a sector which is much more defensive, so then it helps you during bad times also. So that's why I want people to take out that feeling that small cap, mid cap means risky from that perspective, because it's not that small cap or mid cap makes a company risky. It's a business model which makes it risky. Even a metal company, even a large metal company will be risky. But even a small cap hospital stock will be less risky from that perspective. So it's a business model which makes a company risky or less risky from that perspective. That was one point. Second thing, again, there's a lot of, I mean, people think mid cap is very risky from that perspective. But again, if we go back to the definition, what is mid cap? Mid cap is 101th company to 250th company in India. These are not small companies. The 101th company, which is the largest mid-cap company, makes a profit of 2,500, 2,600 crore. It has a cash of 8, 9,000 crore on the balance sheet. How can you call a company which is earning more than 2,500 crore, no debt on the balance sheet, to be a risky mid-cap from that perspective? Probably, so mid-caps has to be seen as a smaller large cap on an aggregate basis. The moment, so I see mid caps as smaller large caps, and I see small caps as more like mid caps. And within the small cap also, again I break up the small cap. Again, small cap is up till broadly around 30,000 crore market cap. So today, if you break up the market cap of India, India's market cap roughly is $5 trillion. 60% will be large cap, $3 trillion, $1 trillion mid cap, 20%, and $1 trillion small cap. Uh, and within small cap, there are 350 companies. So within that, so less than 10,000 crore small cap is where I would say are the risky one. And we have very less exposure to that. So in a small cap fund also, less than 10,000 crore market cap would be 5-6% of the fund actually. So that's why, I mean, people look at what is a mid cap and small cap composition of the fund. But when you look at what sector you own within the mid cap and small cap, one, and secondly, which part of the market cap you own in the mid cap and small cap, that is what matters much more to me rather than seeing optical large, mid, and small cap in the fund.
Aditya, if we look at the mid-cap Invesco mid-cap fund, it had a tough phase in 2022, 22, and 23, but has staged a sharp turnaround in 2024. So, what changes helped those turnaround in the fund?
Chirag, I took over the fund in November 2023. So, so, so probably that was a change. But I mean, keeping that aside, look, I mean, again, when I took over the fund, as I told you, I mean, those 3-4 years were like roaring hot market. Markets were like just roaring like anything. So then you need to put your head down and see where you need to put your money. So again, midcap is a very broad basket. So as I said earlier, we chose what themes to put money. So that we identified 6, 7, 8 themes which look attractive from a longer term point of view. And some of the themes I have already spoken earlier. And these are themes, I mean, which might grow irrespective of macro. Actually, macro might slow a bit. Still, these themes will grow. They might be due to disruption. They might be due to that company might be gaining market share. I mean, there might be different reasons for those companies doing very well. So that's why that was a top-down view from that perspective. And secondly, bottom stock selection within that. Secondly, again, I mean, we brought down the number of holdings in the portfolio. I mean, that time it used to have 80 names in the portfolio. We brought it down to maybe less than 50 names. At this juncture, we have 48 names in the portfolio. Because look, again, I mean, when the economy is slowing, you cannot have a very large portfolio because it is very difficult to then position your portfolio in the way you want to position. You need to sharply position it. So that's why sharply positioning it in the things we wanted with maybe less than 50 stocks was a good enough, because I think less than 50 stocks serves that purpose of positioning your portfolio in a good way. At the same time, it helps you diversify from that perspective, because you might ask me that, I mean, does it increase the concentration risk from that perspective? But we said that we might reduce the number of holding, but we will not breach that 5% top holding in any of a fund. So we will, I mean, we'll be closer, the top holding will be closer to that 5% holding. It will not go up to 7, 8, 9%, because we need to be cognizant of the volatility, what is prevalent across the market from that perspective. So that was one change in terms of top-down focused, bottoms-up stock selection focused, number of reducing the number of holdings, risk management focus. So these were three, four key changes. And again, one more thing, uh, there were a lot of sectors which were doing very well. Like industrial as a sector was doing very well 1.5, 2 years back. Defense was doing very well 1.5, 2 years back. I mean, it was clearly visible that the stock price had run up ahead of reality, because I've seen in 2007 8 these companies that were trading at 7 time 8 time price to sales and 40 50 times P. This is a cyclical sector, and when it's a cyclical sector where margins were trading at the top of, at the peak, you cannot pay such high multiple to a sector like industrials from that perspective. So we reduced a large share of industrials in our portfolio. That helped on an aggregate basis from that perspective. Because I mean, how we think in this portfolio, we don't think that this portfolio can underperform next 3 months, next 6 months. We don't chase momentum at all. We will think, I mean, whether this stock, this sector will help us next 1 year, next 3 year. That is a thought process. So whenever there's a momentum, I mean, we are happy to let go of that momentum from that perspective. Like for example, there's a momentum in auto stocks recently. I mean, we are happy to reduce some bit of auto exposure in the overall momentum. So that's the overall approach in terms of being stock specific, theme focused, controlling the risk from on an aggregate basis. And these are three, four things. On an aggregate basis, it's a, I mean, 20% plus ROE portfolio, 20% plus earning growth portfolio. That's the key met. And one more thing I will share, Chirag. I mean, in my years of learning, one thing I've realized is that you can be a high growth, high earning growth investor, but then you cannot have a portfolio which is completely very high PE portfolio, because when growth investing does well, your portfolio does very well. But when the tide turns, I mean, your portfolio gets rogered from that perspective. That's why having a good balance is very, very important in the portfolio. That's why at all points in time, if I look at the portfolio, 60% will be broadly growth style of investing, and 30-40% will be value and gap style of investing. That's why it doesn't matter to me that which style of investing does well in the market, whether growth is doing well or value is doing well. That's why in a year like last year, when growth was doing very well, we did very well last year. But this year also, when growth has got punished, you can see a performance has been at the top this year also, because it's a very balanced portfolio. Because ultimately, the portfolio has to be a good balance. Because I mean, objective is to be give much more consistent performance rather than give be at the top 1 year and be at the bottom the other year. So these are three, four things, approaches which helped us in terms of turning around our mid cap fund.
But Aditya, is the same reason even for the small cap fund? Because in the last 3 year, the rolling returns, on the 3 year consistency dipped close to zero before recovery. So is this the same reason even for the small cap fund?
Yes, look, I mean, across our funds, the style remains same. Okay. So small cap also, you will see similar theme at play, similar bottoms up stock picking at play from that perspective. So it's a similar style. And again, over there, you will see healthcare as a space be one of the top sectors, financial as a space be one of the top sectors, consumption as a space be one of the top sectors, industrials, we've cut down overweight in that sector. So on an overall basis, the same reason run through most of our fund. Because look, as an investor, when you're running one fund, I mean, your thought process cannot be very different while running different funds. Because I don't want to run that fund saying that, I mean, let me run this fund in an aggressive way and let me run this fund in a slightly different way so that at all points in time, one fund will do well and one will be down. We don't run like that. Whatever be our best approach, we try to run most of our funds in a similar approach.
Aditya, another thing on the small cap thing only, the 2024 stands out with nearly 13% outperformance compared to the BSE 250 small cap TRI. So you have spoken about what has driven this performance, but can investor expect such a gap to sustain even going forward?
Chirag, as in, had you asked our team or me 1 year back, will you deliver the outperformance we've delivered? I mean, no one can visualize what output. You cannot control the output. What you can control is a process and ingredients which go into that process actually. So we are trying a level best to do whatever we can. But then, having said that, the gap, the outperformance is so large. I mean, one should not expect that outperformance. I mean, in going ahead from that perspective. But what I can say for surety is that we'll try our level best to do whatever we can do, because I made you understand our style, what we are looking for, and we are long-term investors, and we don't believe in getting in a company, getting out in a company. We want to back good companies in the small and mid cap where we can stay for the next 3 5 years, and that is an entire approach in terms of fund management we have as a team over here.
Right, Aditya, since we're talking about small caps, liquidity in small caps, that can be a double-edged sword. So how do you ensure scalability and exit discipline while managing this segment?
Look, liquidity is important, Ruchira, obviously. That's why, I mean, look, most of your hard work should go when you, before you include a stock in a portfolio. So in our place, I mean, before we include a stock in our portfolio, a lot of work goes into that. So, I mean, it takes 1 2 months for an analyst to do work on that company before a stock gets included from that perspective. And in case it's a small cap company, the amount of work which goes into that is all the more from that perspective. That's why, I mean, the conviction in a small cap company has to be much more than a mid cap or large cap company from that perspective. Because I think in case you've done your homework well at the time of inclusion, the liquidity risk is taken care of to a large extent. Because look, I mean, lot of these cases, some of these stocks is a one-way street. I mean, you can get in, but to get out is really difficult from that perspective. Liquidity is a challenge, I will say, but then you need to refine your process as an investor before you get in. And that's why, I mean, when you do research on a small cap company, which is maybe an IPO company, you need to do a lot of checks, especially on the promoter, through a channel checks on maybe competitor, or through ex-employees. A lot of channel check you need to do as to how the promoter is and all those things. You need to, so a lot of things you need to do much more in a small cap before you get in. But having said that, you know that some time back, AMFI released that guideline for liquidity monitoring across small cap and mid cap funds. I mean, what I remember vaguely is that I think a quarter of a fund could be sold over a 5 day time period in case a redemption warrants that amount of liquidity from that perspective. So I mean, look, selling is not a problem, but only thing is, problem is that suppose you get stuck in a wrong company and you have to make an exit. How do you make an exit? That is a challenge for sure. But only way to overcome that challenge is maybe to take smaller bets in small cap. One is that, and secondly, do much more work before you get into a small cap at the time of start. These are two things you can do to mitigate those challenges.
Aditya, recently the small cap fund has increased the allocation to relatively bigger small caps compared to the earlier tilt towards the smaller ones. Is this a conscious shift towards stability or more byproduct of the opportunity which arises in the market?
Well, look again, Chirag, this is a conscious shift. Our fund size is also growing. Okay. With fund size, you need to be cognizant of the risk associated with those fund size. So from that perspective, as I said earlier, small cap is up till maybe 32,000 per market cap. So below, I think 8,000-9,000 crore market cap is where companies are much more volatile from that perspective. So we've positioned much more in more than $1 billion market cap, in 8,000-9,000 crore market cap to 30,000 crore market cap. Below 8,000-9,000 crore market cap is hardly 5-6% of our portfolio. So that is by design and by choice, and we would like to stick to that, because that is again out of experience, that in cases where things did not go well, we found it very difficult to exit those stocks from that perspective. So it's better to maybe, stay away from that part of the market where liquidity is getting more and more difficult incrementally.
Okay. Aditya, would you agree that the small cap fund is not entirely buy and hold kind of strategy? And roughly, what's the share of the portfolio would you classify as a opportunity bets in the market?
I will beg to differ, Chirag, that most of our portfolios would be in a buy and hold approach from that perspective. So, and more so in a small cap space, because we are talking about liquidity being challenging, and especially at the small cap end, liquidity is a big challenge. And suppose you take tactical bets in the portfolio, to get in and get out is becoming very, very difficult from that perspective. So, generally, in my thought process, I don't take calls, less than 1 year, 2 year from a time frame perspective. There's never a case where you think 3 महीने के लिए लेते हैं, 6 महीने के लिए लेते हैं. When you minimum think कि 3 साल के लिए लेते हैं, then you'll see what happens. Obviously there are cases where investment argument has not worked out as per what you thought, and maybe you need to exit before that time frame. That happens. One is that, and secondly, look, market, as I said, is market prices in a stock very, very fast. So in a lot of these cases, their market has rewarded a company very handsomely. So it makes sense to maybe take money in some of those cases. So that's why I think approach towards it, like 10 years back, my approach towards investing was more like playing a test match. कि एक बार ले लिया तो शांति से बैठेंगे. But I think my approach now towards is being slightly more agile from that perspective. So maybe it's not yet a 2020 from that perspective, but what I will say is that you need to be more agile, and you need to maybe keep an eye on what are the disruption happening to it, because cycles are becoming much more shorter from that perspective. Disruptions are, you will not be able to see. I can tell you that I like this company for the next 10 years, but 2 years later some disruption will happen. So that's why you need to be much more agile from that perspective. So even though there's no churn ratio from that perspective, I monitor, but across my funds, what I see is that churn ratio is around 40%. And within that 40%, you know that large, mid, and small, every 6 months, Amphi releases a list wherein so many changes happen. Like in this review itself, 10% of a small cap became mid caps actually. So what do you do in that case? So that's why you need to keep changing your small cap, mid cap, to make sure that you adhere to that 65% in small cap or 65% mid cap. So some bit of churn is also triggered to that. So because of these agility and all these things, some bit of this, but generally thought process is, when you buy the small mid cap company, you think for the next 2-3 years at least before taking a position in these companies.
Right, Aditya, one last question.
Sure.
Given how sharp the rally has been, do you expect a period of relatively muted returns ahead? And what should investors temper their expectations now?
Look, again, Ruchira, investors' memory is very short term. Okay. They anchor about whatever has been the recent past. So for last 4-5 years, and people have made so much of money that people are still anchored to those returns. So in case to those people who are anchored around those numbers, I think those people need to surely moderate that return from that perspective. Because over a longer term, in case GDP has to grow at 10%, there's no way that large companies can give you more than 10-11% return. And smaller mid-cap companies can, as an aggregate, as an index, cannot give you more than 13, 14, 15% return from that perspective. So it is always good for an investor when he is allocating money into the market to think that maybe early teen is what return he will get from the market. from a longer term. But having said that, that is longer term. Within this longer term, there are periods when 2 year can have no return, but then the latter half makes up for no return period. So last 1 year, I mean, a lot of investors have been disappointed because markets have remained flat broadly. But I'm sure that these are periods when economy is consolidating, market is consolidating, and so maybe this can continue next 3 6 months. You will never know. Maybe 6 months this can continue further, but at some point in time, 2 years of no return will be compensated in the third year, or 2.5 years at some point in time. That's why it is very difficult to time the market. People who think next 3 year, next 5 year will make money. People who think whether they'll make money next 3 months, next 6 months, they will not be able to make meaningful money from that perspective. That's why this is a longer term game, and people who are in the longer term game will make money in the longer term, and people who don't, don't the sooner people get used to this fact, the better it is for them.
All right. Well, on that note, let's wrap up this conversation. Thank you, Aditya, for the insights.
Yeah, thank you so much, Ruchira. Thank you so much, Chirag.